Last month, everything that's remotely connected to China broke down as the trade tensions with the PRC just keep escalating. This month, many of those stocks have come roaring back, but not all of them. Witness Dell Technologies. In late January, not long after Dell returned to the public markets, I pounded the table on this one. I told you the company had changed dramatically thanks to the acquisition of EMC. It was no longer a play on personal computers and printers. It was now much more of a diversified tech play with lots of enterprise exposure, not to mention owning most of VMware, which is one of our favorite cloud kings. At the time, Dell was trading at $44, and I told you it was just way too cheap to ignore. You got to own this one. And it's been a pretty darn good call, although it looked a whole lot better a month ago. At first, Dell caught fire, rallying to $70 last month, practically in a straight line. But since mid-May, the stock has come right back down, plunging more than $16 from its highs, 23.5%. While it's still up about $10 from where I recommended it, its darn thing has been slaughtered lately. So what the heck happened to Dell? Does it make sense to buy the stock here? Or is something going very, very wrong? Has this stock gone off the rails? The proximate cause of the decline came at the end of May when Dell reported really a not-so-hot quarter. It wasn't terrible. It wasn't great either. Company delivered a modest earnings beat on top of weaker-than-expected sales. The problem, Dell cited some softness in server demand and some weakness in China. Oh, man, the guidance was actually solid, but that commentary really did spook investors, and the stock got hammered. Between Dell's China exposure and a possible slowdown in their server business driven by weaker economies, well, the stock couldn't get much traction. China's become a minefield, people, minefield for the tech sector, worse than other areas, because this is really at the crux of the trade war. President Trump wants to prevent the Chinese from leapfrogging us technologically. Hence the Huawei blacklist. That's about 5G, you know, and the new supercomputer blacklist he rolled out today out of nowhere. Now, Dell got about 11% of its sales from China last year, according to FactSet estimates, although now the company says it's more like the high single digits. At the same time, much like Apple, Dell's potentially caught in the big crossfire here because you also have to worry about how much of its supply chain is based in the PRC, meaning Trump's next round of tariffs, the ones that I'm saying could be opposed for $300 billion, well, it might hit Dell's products. We know China has already started to hurt the numbers. On the latest conference call, CFO Thomas Sweet explained what I'm talking about. These are quotes, okay, and they're very tough. Here's the first one. We did see some slower server growth than we anticipated. This was more pronounced in a few areas, principally China, and in certain large enterprise opportunities, end quote. Wow. Later, Sweet adds, quote, we did see some softness in China, end quote. As for the tariffs, they've managed to navigate the president's first 3 rounds of tariffs, and the company believes it can handle the latest increase from 10 to 25%. They're also planning to adjust the global supply chain in anticipation of a 4th round, which you know I have said is going to occur. Sweet says the company saw more competitiveness in the Chinese server market, and it simply didn't make sense for them to chase unprofitable business. That's just somebody's nipping at their heels in the PRC. All that said, I think most of these China fears are already baked into the stock. I mean, look, this stock has gone from 70 down to 54 precisely because of what I just mentioned. It's not like it's revelatory. I'm giving you the history. Remember, this is less than 10% of Dell's business. Still, we know the Communist Party is thinking about putting Dell on their list of unreliable global companies because it's complying with the Huawei ban, and that would hurt. The other big worry, the apparent softness in enterprise information technology spending. And I'm exasperated by this because a lot of people thought this was very strong. See, now suddenly everybody's concerned about a slowdown, both here in the U.S. and in the rest of the world. It's a slowdown driven by big business. Between the trade wars and the Fed's misguided December rate hike, executives have gotten more cautious. If the economy keeps slowing, Wall Street fears that companies may tighten their belts and cut their hardware spending. I think this is definitely the case. This is, by the way, the kind of softness that is Fed Chief Jay Powell thinking about potentially cutting interest rates in the not-too-distant future. Yeah, so what if the stock market's really high? This stuff is happening underneath. The stocks that are flying are the ones that don't have anything to do with the economy for the most part. How vulnerable would Dell be to this kind of slowdown that we're talking about? When we spoke to CEO Michael Dell back in March, he explained that his company has a lot more exposure to the most critical areas of the enterprise tech spending, meaning the last things that would get cut if business start freezing, their IT budgets, meaning it might not be as bad as the action in the stock suggests. These worries, by the way, are also hitting VMware, Dell's terrific subsidiary. That's a major player in the cloud infrastructure space. VMware is one of our cloud kings, but it's now lagging the rest of the kings. Why? Well, that's the crazy thing. The numbers are good. When VMware reported on May 30th, the same night as Dell, they posted a terrific top and bottom line beat. They announced a $1.5 billion buyback. That's B. But because the earnings guidance for the next quarter and the full year came in a little bit light, they didn't raise numbers, basically. The stock got annihilated, down 7.4%. The very next day. Given that Dell owns about 80% of VMware, and VMware is a $71 billion company, that explains a decent chunk of the decline in Dell stock. On the one hand, VMware stock had run up dramatically going into the quarter. We were talking about it for years. Well, it means it was really poised to sell off no matter what. On the other hand, this company's all about virtualization, allowing customers to take a single server and use it to host multiple digital machines. So investors fear that it might get hurt if the server business is slowing down. However, VMware says it doesn't have much correlation with enterprise hardware spending. The business is really all about helping companies onboard the cloud, particularly Amazon Web Services. Wall Street wanted VMware to raise its guidance. That's what we were really hoping for. But guidance, management, they left it unchanged. Now, here's my view on VMware. And we spent a lot of time on this. I think they were simply being conservative. I don't think there's anything wrong with VMware. I think the sellers blew it way out of proportion. I think they're just trying to make it so the bar isn't too high. I'd say VMware at 173 is a better buy than Dell. It may be more expensive, but that's only fair given its faster growth rates and more limited economic sensitivity. Dell has other subsidiaries too, although they're much smaller. Now, one of them, Pivotal Software, wow, it's lost 40% of its value in the last 3 weeks. The weakness at this cloud-based software development platform is tougher to explain. Pivotal slashes full-year revenue guidance without much of an explanation, blaming a sales execution in a complex technology landscape. Ouch. These are all real concerns, but when you put it all together, Dell is sticking to its guns, standing by its full-year earnings forecast of 605 to 670. Now, if they can deliver those numbers, think about this. This stock is selling at 8.5 times earnings. I just did a piece last night about the Dow stocks. Most of them are triple that. 7.4 times next year's numbers. When you see a multiple this low, though, you know what it means? It means Wall Street's expecting the estimates to come down. However, at these levels, I'm actually betting most of the weakness is already reflected in the stock price, and that assumes nothing gets better. If Michael Dell is right that the company's less sensitive to a slower economy, I think this could be a fabulous buying opportunity. If we get a trade deal, oh, it's a rocket ship. Bottom line, unfortunately, Dell stock is shackled to China. So it could get hit again next week if we don't get any kind of trade deal from the G20 meeting. But if that happens, I think then you can buy Dell into weakness. It's just gotten too cheap to ignore. I need to speak to Andrew in New York, please. Andrew.
Hi, Jim. This is Andrew calling from Brooklyn, New York.
Yeah, go Brooklyn. What's up?
Hey, Jim, I want to just let you know I watch the show every day. I love the show and a big Brooklyn
Man, I like that. I like that. It's Brooklyn's really the house of kings is the way I look at it.
Oh, it's the best.
Like the Medicis of New York.
Highly recommended. I want to highly recommend your restaurant.
Thank you.
Okay, I want to give a shout out to my wife Annie, my parents Allie and Jeff on Staten Island. So I'm calling today in regards to Alteryx, ticker symbol AYX, and it's really a two-part question. I'll make it quick. The first part is, what do you think the short-term year, opposed to long-term 5-year growth potential is for Alteryx? And the second part is, do you think Alteryx would be a possible candidate for acquisition in the future? Some competitors would be Tableau, Microsoft, Hewlett, IBM.
Well, but remember, they do data storage, they do retrieval and reporting. Yeah, you're right. I have liked Alteryx. I made a big mistake. I filled out to be a customer of Alteryx, and now everywhere I go, it follows me. Every single time I put up an Alteryx ad. Alteryx is a very good company. That's a cool call. I like it. Felicity in Florida. Felicity!
Hello, Mr. Cramer. You are my mentor.
There you go.
I'm
Thank you.
a long-time listener and a first-time caller.
All right.
I'm calling about CyberArk. I'm up 80%. Should I keep going? Should I sell it?
Oh,
what should I
but
do?
Udi Makati keeps delivering. They've got a great business, but up 80%. We're being piggish. What we're going to do is we're going to take a quarter of it off the table on Monday. That way I feel a little better. Otherwise, all I'm going to do is sit here and worry about you. Congratulations on a great trade or an investment, depending upon your time horizon. All right, Dell could get hit, depending on the G20 meeting. And if that happens, buy. And stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.